Hello, everyone, and thank you for joining us today. My name is Andrew Dix. I'm the founder of the Crowded Media Group. We are the publishers of Crowdfund Insider, and we cover all things fintech, most specifically online capital formation or crowdfunding. And today, we have a really interesting topic to discuss: crowdfunding to an IPO, or raising money online and becoming a reporting or publicly listed firm. We're really fortunate to have multiple experts with us today that can share unique perspective into this process, whether it's something that you're considering or may want to do in the future. These are the people that can explain this all to you. So we have Matt Goldstein from DealMaker returning with us. It's always a pleasure to have him on board. Richard Carlton from the Canadian Securities Exchange. We have Jason Paltrowitz with OTC Markets, and then an issuer, Stephen Rossi from WorkSport. So I'm going to ask each of you to go around the clock here and give us a little idea of what you do, what your role is, and how you play in capital markets. And I'm going to start with you, Jason, since you're on my right-hand corner here.
Sure. Well, thank you for having me, and I look forward to the conversation. So my name is Jason Paltrowitz. I'm Executive Vice President and Director of OTC Markets. We are the home to over 12,000 public securities, both from around the world and here in the U.S. About 85% of the companies that trade on our market are actually international. But we are very active in the early stage growth developing company space. We pride ourselves on helping issuers learn what it takes to be public, the pitfalls of being public, things to think about, and the advisors with whom they should work with in order to have a successful public market. From a Reg A perspective, we've been very active in promoting Reg A and being at the forefront of trying to get Reg A kind of more widely used. We think it's a great launch pad for companies that are looking to join the public markets. Misperception is that we are not the public market. You actually are public if you're traded here. And so we spend a lot of time in that space helping companies learn how to be public, which is important, and then grow up within the public markets.
Thank you, Jason. Matt, DealMaker.
Thanks, Andrew. Great to be here. My name's Matt Goldstein. I'm one of the founders of DealMaker. DealMaker is an online platform for raising capital. That's where issuers open an online offering and manage their own capital raise themselves, whether that's a private placement under 506B, where they're bringing in friends and family, or whether that's a marketed offering aimed at the general public, which many people know as equity crowdfunding. DealMaker is a market leader in both. We've processed over $2 billion in online capital formation over the last 5 years. And we've brought a number of companies the full life cycle of capital formation, from building their initial community, returning to that community for a Series A, Series B, Series C, and ultimately reaching the destination of public listings, where their crowdfunding shareholders maintain an important role in supporting the company while it's in the public markets. Delighted to be here.
Thank you, Matt. Richard.
Yes, thank you, and a pleasure to be with such an esteemed group and a large and engaged audience. The Canadian Securities Exchange is, like many of our clients, a startup itself, now 20 years old. And the exchange was founded to provide an easier path for public capital, or access to public capital, for entrepreneurs, not just in Canada, but from around the world, looking to tap Canadian, what we refer to as Canadian public venture capital. And we've had a tremendous run, particularly over the last 5 to 10 years. Statistics from other exchanges suggest that in 2021 and 2022, we added more listings than any other exchange in the world, which is kind of cool for a startup to say. Took us a while. But we see ourselves as part of a continuum of private equity sources, public equity sources that are all part of the life cycle of a company. And for us, we like to work with folks in the private space to see issuers come to us with more diverse cap tables, better funded, more engaged shareholders, which will make their success as public companies much more likely. And so again, we're delighted to be joined with such an esteemed group here today. And I think we're really going to learn a lot over the next hour.
Thank you very much, Richard. Stephen, you actually have gone down this path. Can you tell us a little bit about WorkSport?
Absolutely. Thanks for absolute honor to be here today, Andrew. Thank you. I'm Steve Rossi. I'm the CEO and founder of WorkSport, presently trading on the NASDAQ exchange. I've been a business owner since my teenage years at 18. We first went public via reverse merger, accessing the OTC markets in 2014, which gives me nearly 10 years capital markets experience as a CEO. We've traversed from OTC markets to NASDAQ. I've had experience with Securities and Exchange Commission, SEC, to OSC here in Ontario. I have experience in capital raising using Reg A. That's how DealMaker and WorkSport are familiar with each other, and myself and Matt. So lots of experience from capital formation to capital raising to OSC and SEC, investor relations, and behind all of that, or in the forefront of all of that, is launching a product that is sold in the market.
Awesome. Thank you a lot, Steve. So first of all, you do have a really cool product, and I've been to your website several times now, and my only wish is you provided something for the Jeep Wrangler. Okay, I want one of those tops for the top of my car. So if it's not in the queue yet, please start working on it. But for anybody who's here joining us that has a pickup truck, you should check out his product because it is very interesting. So Steve, your shares, as you mentioned, they trade on NASDAQ. It's a ticker symbol WKSP. I want to start with you kind of setting the stage that you raised capital, private capital first, and then you went to OTC and then NASDAQ. How many times did you go to the market and raise capital via venture or online capital formation, either Reg A plus or Reg CF or Reg D 506C? How many times did you raise money before?
Great question. So in our lifetime, we've raised capital, in essence, 3 major buckets of times. We've issued, of course, notes and smaller offerings. Well, not offerings, but notes, which I wouldn't consider in this case as a debt instrument often. But when we initially went public via RMO, reverse merger, in 2013, 2014, we raised private funds from friends and families, those in the local area where at the time I was stationed from, which is here in Toronto. After that, it was preparing to be able to appeal to the mass per se. And the second time we raised capital was through a Reg A, Regulation A offering that started in 2019 and closed in 2020 in terms of planning, probably later 2020. And the third time was almost a concurrent offering in terms of a listing, a transference from OTC markets to NASDAQ markets.
Okay, so obviously, when you want to list your shares, sometimes you have to. There is an ambition. There's a purpose. Frequently, it's liquidity. Early investors need a way to exit. That's typically via an acquisition or to trade their shares on a venue. Why did you want to become a publicly listed company? You said you did a reverse merger, but this was something that you wanted to provide liquidity. Was it a way to tap other markets for growth capital? What was your motivation at that time to do the RMO?
The motivation at the time was a lot of founders were similar to me, are similar to me in the sense that they'll do whatever it takes to grow a business. We've had countless investors say, this business would be a fantastic private business. But oftentimes large businesses, founder operated businesses take years to grow. Capital in the private equity markets can be challenged. And then the exit for investors is an acquisition through what's typical private equity. There's a shedding of the skin, often a major loss of DNA. And it wasn't that appealing to me to think, let me build a business a very challenging way, accessing private equity markets, and then, be bought out and retire. When going public, you have the opportunity to have a good amount of equity in the corporation, still seeing the same or similar exit opportunities as all shareholders do. So everyone gets to enjoy the upside if there ever were to be an exit, while accessing the broader capital markets, in a phased approach. When you're a tiny nano cap issuer, crowdfunding is fantastic. But I would say that crowdfunding is fantastic for even larger issuers. But then accessing the capital markets through banker offerings are simpler transactions, perhaps even faster transactions, where it allows you to take advantage of M&A opportunities or broader expansion opportunities. But both have great crowdfunding and underwritten offerings. Both have fantastic opportunities.
Okay, so that makes sense to me. And you're still a controlling shareholder of the company. You haven't lost control. And that's one of the risks if you're just using venture funding is you can frequently, lose that control and be jettisoned. And that's one of the benefits of raising money online for crowdfunding. I want to jump over to you, Matt, because you are the enabler. You had mentioned that you guys have now enabled over 2 billion using your technology. You need to update your website because I went there today to look at this number. It says 1.85. So since the last time you updated that, you've grown even further. So congratulations for that. You work with a lot of different issuers using the full stack of exemptions, including Reg S and private placements and all that. Under Reg A plus, an issuer can trade their shares immediately after the funding round. I'm kind of curious as to what you're seeing in the online capital formation market, specifically with Reg A plus, for issuers that want to become a publicly traded firm. And maybe we can start with that because you guys power this in the background.
Yeah. Okay, so here's the big idea behind DealMaker. It all boils down to this one observation. Raising capital is selling securities. Do we agree? Richard and Jason, do we agree? Raising capital is selling securities.
Yes.
It's just sales, guys. It's just sales. And sales follows a process and a methodology. And the analogy in the retail markets, you can sell things online where 10 years ago you thought, oh, I'd never buy shoes online. I'd never buy shirts online. I'd never buy shares online. Today you buy those things online. And so when I say the big idea behind DealMaker is that it's just sales, what I mean is what we've built is a technology platform very similar to Shopify in many ways, where what you're doing is running a sales campaign. And if you think about what an issuer needs to do to sell a product, what Steve Rossi has to do to move units, it's like 90% of the way to raising capital. It's having an authentic message. It's sending a signal that pierces the noise on the internet. It's having a product that meets the needs of a market. It's telling a story that resonates with a certain community. It's winning the trust and having the respect of the members of the public who are asked to open their wallets and put down a credit card. And if you do all of those things well in order to sell your product, we say to any issuer, then you'll do those things well in order to raise capital. And so fundamentally, what we believe is that the brand building of corporate America, who have Instagram followings and who have, email newsletters, is most of the way there to raising capital. And if you can build a community that will support you with their product purchases, you can build a community that will support you with their investment dollars. And if you take that one step further into the public markets, we believe strongly that the investors that come into the shareholder base through crowdfunding, because you've won their trust, because they've engaged with you over time, because you've delivered what you said you were going to deliver, otherwise they wouldn't have invested. If you've done all those things well in your financing rounds, you should have a community that will support you in the public markets.
Okay, so go ahead.
Well, just to kind of sum it up, we believe if you are able to bring your community into your shareholder base, turn your customers into shareholders through online capital formation, that community will be there for you in the public markets. And you should see their support when you have negative news cycles, and you should see their support as long-term holders rather than, what I think used to be associated with retail trading behavior, which was you'd rather have institutional. I think today you'd rather have retail.
Okay, so that's very helpful. What are you seeing today for your customers, your clients, and their interest to trade their shares? And if we could start with Reg A plus, because that's a streamlined process in comparison to other exemptions. Do you get a lot of interest from companies raising capital online using your service to indicate that they want to see liquidity in their shares?
Yes.
Absolutely. Is it a high
Can
percentage?
I talk about it more? Yeah, I think it's more than ever. I think in the early days of crowdfunding, right, like many innovations, right, there's a whole literature on the diffusion of innovation. Clay Christensen writes a number of important works on this, but there's kind of a pattern. It starts with early adopters, and over time it moves mainstream, and we followed that trend. Right, we've got more brands than ever who are mainstream brands and who want to be mainstream brands. And what do mainstream brands do? They end up in the public markets. And so whether it's a Canadian company that moves through CSE and OTC and settles there, or whether they're moving like Steve did from OTC up to NASDAQ, or whatever the case may be, we see more and more interest today from an earlier stage to build a community for the purpose of supporting the kind of destination of the company in the public markets. And I think that's a trend that's just going to accelerate and continue.
Does this hold true for firms that are raising money under Reg CF and Reg D too?
Absolutely.
Right.
And ultimately, if I can jump in, it really is all about the cost of capital. So that with the liquidity that is implied by a public listing, you will see a significantly cheaper cost of capital. And that really is behind all of this, all of the innovation that's taking place. Because if we go back a generation and we think about the securities dealers that were managing the old-fashioned type distributions, IPOs, private placements, or whatever, that community just doesn't exist for entrepreneurs in North America anymore. We've got to find substitutes for it. And this is where DealMaker and others are trying to basically fill that bill with innovation and the opportunity to scale the technology that we have to meet the funding requirements of entrepreneurs.
Okay, so Richard, you mentioned something earlier that you were one of the biggest issuers or platforms for new issuances. I think in the world, correct me if I'm wrong, in the last year or something like that. So you're seeing some success.
Yeah, now to be fair, not by market capitalization, but number of companies.
That's fair. I think that's important. What are you seeing today for companies that are raising money online and then coming to your platform to trade their shares? Does it match what I'm hearing from Matt? What are you seeing specifically?
Yeah, as I mentioned at the outset, we're certainly supportive of any initiative which enables these companies to more efficiently raise capital and diversify their shareholder base before they reach the public markets. Because again, that has a very powerful indicator in terms of how successful the company is likely to be post-market. I was also going to say, Matt said something very important about the companies that are basically engaging with their customer base for their primary product, and the skills associated with moving that to basically then selling them stock. I mean, I was thinking Jason and I are the only two old enough to remember Victor Kayam, the old Remington thing. His wife bought him a Remington shaver, and he said, "I was so impressed, I bought the company."
You're dating yourself.
That's exactly. I know I'm dating myself, but that's exactly what we're talking about here. Somebody looks at that truck liner and goes, "That is a fantastic product. There's geniuses behind this product. I want to back them." And understand that between us and the nameless exchange in Canada, there are 2,400 publicly listed venture companies. The United States, there are thousands more. It's busy. It's crowded. and to get the attention of the investors that you need to support your objectives, whether it's organic growth, acquisitions, product development, whatever that might be. You have to be really good at standing out from a very, very crowded crowd, if I could call it that. So the skills associated with again successfully engaging with that potential shareholder base are exactly the same as engaging with a customer base online. So what we're seeing right now, again, a lot of mining companies are hitting the market, and this is all about the electrification of the economy, decarbonization, whatever you want to call it. So we're certainly seeing a lot of lithium, graphite, cobalt, zinc, nickel, copper companies come to market, along with technologies that are designed to support the introduction of electric vehicles and so on. And that's obviously a theme that investors are engaging with because people are, again, supporting that overall direction. They see it as something that is on the come and a theme that people can engage with. We had a lot of success in the cannabis space. People wanted to support the legal production and sale of cannabis in different jurisdictions in the United States and across Canada. And we saw tremendous investor interest in those themes around the cannabis space. So again, it's really all about making sure that these companies have engaged with not just their customer base, but with their shareholders before they hit the market, because that will then support better price discovery, more liquidity, and more liquidity, of course, breeds easier opportunities to raise capital down the line.
So Jason, I want to ask you a similar question. OTC Markets was early on in recognizing the opportunity with Reg A plus. You guys have always, touted your ability to provide a listing or trading venue for venture firms. What are you guys seeing today for companies that have raised money online, Reg A, Reg CF, Reg D, whatever, and then they've moved over to OTC Markets to trade their shares?
Yeah. So first of all, we tout ourselves. We were the first big Reg A that went public.
You were
public on our OTC QX market. And when Reg A, the new Reg A, I'll say, right, because Reg A has been around for a while, but kind of the amended Reg A was really designed to make capital formation easy for early stage entrepreneurial companies. And so utilizing kind of our market structure as a way to help companies be public through crowdfunding. One of the big standouts is that you could be public and only be a semi-annual filer versus what's required on an exchange, which is a quarterly filer. So it really was a way to take these early stage companies and help them be public. For a lot of those companies, they didn't even realize the fine print was that once you did a Reg A offering, for instance, you were immediately kind of public tradable. And so the mechanisms through that to become immediately a public company post the offering and how that worked out. Like everything else, though, what we have seen from those early stage well-intentions is some hiccups. And really around that, or companies, where you're an early stage founder and you're kind of really spending all of your time trying to build your business and sell your securities through a Reg A offering and grow your company. Some mistakes have been made along the way. And one of the mistakes we've seen, or the things that we're looking at, are companies that probably weren't ready to take on the burdens of being on a full exchange listing, and that kind of grew up a little bit too soon and are probably, regretting that in the long run. We talk about if you can sell your shares the way you can sell your product. Well, when you sell your product, you have to be there for the long term to support the people that bought your product at the beginning. And if your capital formation ongoing does things like dilute your existing shareholders, do things that drive your stock price down, that doesn't support those early stage adopters of your product or your shares, you're being destructive in the value creation that the public markets can provide.
Okay.
So we as a company, right? We started as a private company, and we were in the private markets, and we went public on OTC Markets at about a 50 million market cap. I think we're about 600 million now. And so there are things that you can do to grow up in the public markets the right way. And there are things that we just think you have to be a little more thoughtful about, as once you've gone public, how do you support that secondary market for your early adopters, your other shareholders, and ongoing?
Okay, so I want to jump back to Steve now, because Steve, we had a conversation the other day where you talked about some of your true life adventures that you experienced when you went through this process. And I found it enlightening. And I think if you could share some of the hurdles you encountered and some of the mistakes you made, I think that's helpful for everybody, because while it's anecdotal, it's also, actually happened to you, and you have the battle scars to prove it. So what were the hiccups? What were the challenges that you experienced that were unanticipated in your path to going to OTC and then to NASDAQ?
Consultants, advisors, for the most part. When business owners, there's a transition from a business owner to a capital markets CEO, and oftentimes many business owners are, not to be polarizing, they're nerds like me. Like I'm a truck geek. I love tonneau covers. I love solar. I love battery. Every part of my introduction to who I am was about my experience in the capital markets, fundraising, SEC, audits, corporate compliance, SOX compliance. All of these things are not what I set out to do. These are things that you have to learn how to do, because your lack of knowledge or experience in the capital market almost exclusively gets taken advantage of by an unwilling or unsavory new shareholder. I don't know SOX compliance, but I'm public now. And guess who that is? That's an advisor or a consultant that's going to get some shares for teaching you how to do what you don't know how to do. So I was started my first business at 18. Here I am in my early 20s with a business like most that has more demand than capital to grow. So I go to a friend and I say, hey, it's time for my business to grow. It's time for us to access the capital markets. I know you're involved in the financials, in the financial markets. Can you help fix a loan for WorkSport? And their advice to me in my early 20s was, well, if you want to gain capital, you have to go public. Here we are a whirlwind later, like most CEOs and founders and young entrepreneurs, willing to do whatever it takes to grow your business, saying, I'm in. If it means I'll get capital for the business, I'll do it. Fast forward 5 months later, I'm the CEO of a public company. There's no new money in. Those advisors took the statement was, Andrew, exactly this. Do you want to own 100% of nothing or 70% of something? So I was like, I'll take 70% of something. They took 30% of my business. I went public. There was no deliverance of capital. They exited their position of their 30%, like sold it into the market, and carried on. So here I am, in my early 20s at this time, or mid 20s at this time, CEO of a public company, no idea of anything about the capital markets. And I have increased burdens. I have these burdens of being public, audits and whatnot, and it takes tenacity. You can learn, but it takes tenacity to stick with it and keep your nose above water. Our first deliverance, our first sigh of relief was 5 years later when we met DealMaker and we did a Reg A. But the last thing I'll say, because I could yap for hours, is again, to reiterate, what you don't know, which is a lot, as an entrepreneur to that transition to being the CEO or management of a public company, can oftentimes be taken advantage of. Learning is critical thinking, and learning quickly is an asset. And the OTC markets was a fantastic. I favor all markets, but we had we had a fantastic experience on the OTC markets. But the last thing I'll say, which is Capital Markets 101, and I'm sure Richard and Jason will agree with me, is individual CEOs that have no idea how capital markets work. They think I'm going to be public and immediately my stock's trading. Everyone's interested. I think that the two foremost individuals are on this panel today that could tell you there are more illiquid companies than liquid companies. And when you have a public company that's illiquid, it's useless.
It's not like the movies, right? So I tell you this, I would be upset with those advisors that took 30% of your company and then vaporized and disappeared and took the money and run. That would, if I saw them crossing the street and I was driving, boy, I'd hit that accelerator. Anyway, I want to jump over to Richard because you and I had a conversation the other day about unscrupulous characters who operate in this private to public ecosystem, and I thought your perspective and insight was pretty powerful. Can you share some of that with us now?
Well, I'm not the guy who just published a post. We're
going to get back to that. We're going to get back to that
on the topic.
Be wary of the guys that buy investment bank names that sound good from 20 years ago.
Yeah. No, that's right. In fact, I think they probably advised Victor Kayam on the purchase of Remington Racing. But no, Steve is absolutely right. That and really underscores my point from earlier, which is companies that come into the public markets with that diverse shareholder base, which has been prepared through, whether it's Reg A, crowdfunding, Reg A plus, or whatever, with that engaged and diverse shareholder base, in fact, are a much better position to resist the kind of promises and blandishments that Steve experienced at that early stage of his life as a company. And so, again, kind of like the real estate people say, it's all about location, location, location. From a public markets perspective, it's your cap table, and your cap table. Any investor at the private or the public stage that is looking to put serious investment dollars into your company is going to look and see who's there, what's the makeup of this company, what percentage do the board of directors and company management own? Are they engaged? Are they in it for the long haul? And then, of course, the advisors. They're looking to see, is there a potential overhang? Because as Steve outlined, and this is not an unusual state of affairs, not only do they leave you broken and bleeding by the side of the road, but that 30% shares that get dumped onto the market, I can assure you, do not help your share price one bit. In fact, it craters as a result of that. So I think it's really important for CEOs before they go public to, talk to their peers, talk to the exchange. We have, I wouldn't say it's not a recommendation service or whatever, but, we know who in effect, the good actors and the bad actors are, and we can subtly steer you in the appropriate direction to get the kind of information you need to do a successful pre-public round of investment that, as I say, de-risks your company once it's in the public sphere, and to ensure that you get access to the resources that you need to learn how to do the things, to acquire the disciplines necessary to be a successful public company CEO.
Okay, that's really interesting, really, really helpful. Stay away from the bad actors, talk to the people that have your best interests at heart, and that would be you all here speaking today. Now,
and I think, to just reiterate what Richard said, because we're seeing more and more of it, of these advisors that are being proactive in sending out decks and reaching out to companies that they see in the public market, whether it's on our markets, whether it's companies that are doing Reg A's that see it, right? So being proactive about sending out decks. I'm looking at one now that says, we can raise a ton of money for you. You have to do an exchange uplist, and, this is what's going to happen. It's incumbent upon those companies to just stop for a second and look at, to Richard's point, who they are. What are the tombstones that are on their website? One needs to only look at some of those tombstones and then just look at what happened post-transaction to kind of scratch your head and say, yeah, maybe they raised 10, 15, 20 million, but what happened to the security 90 days, 180 days, 2 years after the fact? And that's a great indicator for the type of offering that you might be getting yourself into. And then really thinking, I could do a private transaction and maybe offer shares at a bit of a discount. That might be significantly better than the dilutive financing or the uplist that I'm undertaking with an investment banker that's coming to me and telling me how great everything's going to be. And then I look at the fine print of the amount of money that it's going to cost me to do that. And I'm not saying that's not an avenue to take, but you just really have to be thoughtful in making those decisions.
Yeah, it's kind of
Yeah, and you really have to.
It's kind of a buyer beware.
Sorry, I was going to.
Yeah, go ahead, Richard.
Yeah, no, I was going to say one of the red flags is, of course, in the compensation. That if the compensation is not tied to their success, then, as I say, it's a pretty strong signal that they may not be as supportive of your interest as they might.
Unsavory characters.
And Richard highlighted a study that we did, but we looked at a number of uplistings from last year. One of those things in compensation, it's amazing the number of deals where bankers took warrants. So you're already compensating them for doing the transaction, and then you're providing them with, a warrant that's dilutive, that's compensating them further, but is actually doing harm to your existing long-term shareholders in the form of the dilution that they undertake when they exercise those warrants. So it is important to look at those things.
So Richard mentioned this study that you just recently published, which was really, really awesome. I read it the other day. I'm going to go back and reread it. And we may have it available to share with the people who are attending this webinar. Could you share some of the statistics that you published on that post, Jason? Because I really found it enlightening and informative, and I really think it's helpful for people who are considering going down this path.
Thank you. And I just want to preface this. This is not us saying that an exchange, uplist, or IPO is a bad thing. Quite the contrary. We think there is a right time for this, and uplisting to an exchange is important. And I think WorkSport's a good example of a company that maybe had some trials and tribulations, but is being successful in that. So I don't want people to walk away thinking it's OTC versus the exchanges. It's not. But when one looks at the type of uplist IPOs or microcap IPOs that have occurred over the years, and we only looked at last year, it becomes painfully obvious certain things that kind of jump out at you. So we looked at the 91, what we'll call microcap IPOs or uplists from last year. And those tend to be the ones that were about 300 million or below in market cap on the event date. 92% of those are below the offer price, with the average being negative 64.8%. So people will say, oh, the markets were down last year. They weren't down 64.8%. 34% of them are already on a non-compliance list. So they're already out of exchange compliance. And 51% of them have had to do reverse splits either in advance of or just after. And when you talk about red flags from an institutional investor perspective, splits before an uplist or just after, that's a red flag. That usually tells an institutional investor that a dilutive financing or a suspect financing is underway. Interestingly, that over half, 51%, the same 5 bankers.
Do you want to mention them by name?
I won't mention them, but I kind of alluded to one of them. If the name sounds familiar from when Richard and I were children, there's an indication. And then 2/3 of these deals had banker warrants attached, right? So those are some of the big headlines, but those tell you something about the financings. These are companies that probably weren't ready. And that did a deal because it seemed like a good idea. There was a play, they needed capital. This seemed like a quick route to capital. And then if you look at the graphs on these, it really has become problematic and sets off this cycle of exchange noncompliance, which is usually a bid price deficiency, which usually results in a reverse split to get them above the dollar, which never really lasts that long. And they fall below the dollar and they're on a non-compliance list. By the way, all of those things scare away institutional investors and long-term shareholders and buyers of a product that were early stage shareholders. And so it creates this vicious circle. All the while, the banker has been paid and left. You're spending hundreds of thousands of dollars in lawyer fees and SOX fees and all of the things that go along with being a public company. And you've diluted, almost out of existence the original shareholders. And so again, there's a right way to do this, and there's a right type of transaction, and there's a right deal. But money for the sake of money, when those shares aren't being placed with investors that have your long-term interests, but are rather unregistered stock flippers, right? The same 50 people in every transaction gets these things. Then that's just not the way to go. And so if you look at that cohort, when the average market cap on the day they listed was 213 million, as of the close of August, the last day of August, the average market cap was 56 million, right? That's a tremendous loss in value. And one just has to question, was it worth it? I'd love to be able to go to all 91 of those CEOs at the end of that and say, was it worth it? And we've seen deals in there where the offering was less than 2 million, right? So somebody's going through all of that to raise less than $2 million. We question.
Can I say?
Yeah, go ahead.
Can I say something just to cheer everyone up?
Yeah.
Look, I think, Jason, you're hitting the nail on the head, and Stephen, you alluded to it too. But if we step back, what are the conditions under which bad actors thrive? What are the conditions under which founders end up ceding control of the capital raise to, an expert? It's asymmetries. It's informational asymmetries. It's expertise asymmetries. Our message to the world and to founders and to those attending this webinar, many of whom are founders and looking to raise, is that you can do this yourself. Founders can do this themselves. They can raise capital themselves. They can build a community themselves. Stephen, not to put you on the spot, but I'm happy to share, when we did our work together, you did a lot of it yourself, right? And I think because of Reg A and because of the progress in the regulatory environment that allows issuers to target the retail public without eligibility requirements to be accredited investors, the whole world out there, if you can sell your product, you can sell shares. And so, our message is certainly one of, and Andrew, it really helps that we do these webinars, because I think the educational piece is so important. I think we're all in the business of seeing issuers succeed, right? And I think, our message to the founder community and to the issuer community is, you have the ability to raise capital yourselves. You don't need to turn over your control of your capital raise to people who make big promises and who might not necessarily be aligned with the companies and the shareholders in the long term. But you can use the crowdfunding exemptions, and you can turn your own community into a source of capital. It can be done.
Yeah, and I was
going to say Reg D, Reg CF, Reg A.
That's what it's
are great ways to raise capital, and whether it's stay private a little longer or stay on an OTC market a little longer or not do the type of toxic financing, and get you to a place where eventually when you do that listing to a US exchange, you're ready, right? You have the investor base that's there that can support your company on an exchange, rather than, like I said, the investors that really aren't interested in your best interest.
Yeah, well.
Yeah, and as a result of the quirk in U.S. securities law, and Steve is in fact a poster child for it, Canadian companies can use a number of those exemptions to raise capital in the United States from U.S. investors. So tremendously powerful tool for Canadians who may think the capital market here is maybe a little small, or they may not have an appetite, or may not have the specialist investors. Again, there's a genuine opportunity, pre-public even, for companies to build mindshare and a shareholding base in the United States through.
Yeah, absolutely. So Matt, I want to jump back to you a second. Beyond raising capital, helping a company raise capital, what other support, advice can you give to a company that is heading down this path? Steve gave you a nice shout out, because he said that inevitably you guys kind of saved his bacon, so to speak, by helping him raise money under a Reg A plus. What other services do you provide? Do you shareholder management, cap table management, advisory? You help them steer away from these unscrupulous characters that are just looking for an opportunity to fleece you and run?
Great question. So listen, ultimately, we believe the power should be in the hands of the issuer. And I appreciate the compliment from Stephen, but I would say all we did was help provide him the tools so that he could run his race himself. And that's what we tried to do. So yes, we own a transfer agent, which will manage the books and records. That should make it a little bit easier for the issuer. We own a marketing agency that's available to help issuers create collateral and pierce the noise of the internet and send signal and do marketing and create a funnel. But at the end of the day, the power is in the hands of the issuer. They drive the capital raise themselves. They know how to sell products, which means by definition, they know how to create trust with individual consumers and persuade them that they're the right bet to make when opening their wallets and buying a product.
Okay. All right. That's very, Steve, I'm going to go back to you for a second, because you said that you worked with DealMaker. They helped you raise funding under Reg A. Going forward, if you need growth capital, which is pretty common for an early stage firm, and I consider you early stage, are you considering raising money online, whether it's Reg A plus, it's Reg D 506C, maybe you're looking at venture funding, maybe you're looking at something else. You have a lot of options. What would you consider now?
It's the, as pointed out, the answer is Reg A was fantastic because you're allowed to market to generally less accredited type investors. Whereas now that we're on the NASDAQ exchange, more with the scrutiny that we have what's called an ATM. ATM is an amount of shares left in reserve for us to literally trade into the market if we have an up day. So if we're trading heavier volumes and we're up 5% that day, we can sell our own shares and collect the proceeds with very little commissions. So you would expect that would work out just wonderfully. However, with the Reg A, Matt said it's been said in this panel so far, in this discussion, sell a product, sell a share. The Reg A opportunity is very strong because you're soliciting to those that are driving pickup trucks that may own or want to buy a product. And that solicitation is critical, saying, hey, here's who we are, and buy a product, buy a share, buy a product. Either way this goes, we want you as part of our family. During the Reg A process, our shareholder list went from 500 to 20,000. Through aftermarkets and whatnot. We have a big cap shareholder list, which is great, and that's what we want. Whereas on the markets, on NASDAQ markets with the ATM product, selling into the market may actually consolidate your shareholders. It might be one large hedge fund that's buying or something. So the answer to your question is, heck yeah, I would. The the Reg A process for us was probably one of the most fulfilling experiences I've had in the capital markets.
Jason and Richard, do you have an opinion on, what Steve should consider going forward?
No, I don't have an opinion. I think Steve's pointed out, right? The one opinion we have is be thoughtful about what you do and what you're trying to achieve. And I think his answer was just that. It was incredibly thoughtful to what he's trying to achieve. And I would, my opinion is that every company should be thinking about that, not just for the short term, because you need funding today, but for the long term and what that's going to do, again, to your existing shareholders, to your company, to your stock, to your outlook, and to your ability to go back to the capital markets the next time. And what one has to do in order to go back to the capital markets the next time. Because every bad financing, every bad decision, it feeds off of each other. And so you'll find companies that make a bad choice the first time don't have really good choices the second and third time. And so I think you're getting a really good example of the right way to do these things and the thoughtful way to do these things.
Yeah, Steve refers to the ATM facility, which is at the money sales. And I think it's fair to say regulators in the developed markets around the world are looking at ways to reduce the cost of capital for issuers with similar sorts of vehicles. So we have ATM programs in Canada as well for issuers. We've also recently introduced something called the life exemption, the listed issuer finance exemption. And that is, again, companies are able to market stock to existing shareholders without a prospectus, without a discount, and it's free trading immediately. So different than a private placement. But again, trying to achieve that same goal that Steve talked about, which is having the opportunity to, when the market conditions are appropriate, for public companies to get growth capital from the folks, in effect, who have, in the life exemption, who've already bought in, and with the at the money, people who may not have been able to take a position in the company are able to get a position in the company without having to go through the whole rigmarole of a formal IPO process or secondary offering under a prospectus.
Okay, awesome. Steve, if you had to do it all over again, hindsight 2020, how would you have proceeded?
He would have started making something for a Wrangler.
Yeah.
Absolutely.
If I had to do it all over again, I wouldn't change many things except for maybe mature the company on a little bit more. One of my famous sayings is a commonplace, but just rely heavily on if it quacks like a duck and it looks like a duck, it's a duck. And as simple as a statement as that sounds, like people almost laugh when I say that, it's just CEOs, forget about CEOs, founders and entrepreneurs just have such a finely tuned gut that they often don't listen to. So I would just listen to it a little bit more, and then continue on execution. Execution is the only thing that's rewarded, and is what made generational wealth and victory stories like empires that are built in the US and Canada on a regular basis. Just execute, focus on growth, and I would have done everything the same, just followed my gut a little bit more. That's all.
Okay, awesome. I have a few more questions, but I'm going to jump over to audience questions because I see we have a few here, and see if we can get through a few of these before we run out of time. How about Richard? Are there specific sectors or industries that you've seen more commonly making this transition from crowdfunding to IPO on the CSE?
I would say that companies which have themes that appeal to younger investors, which seems like an obvious statement, that the older folks may not necessarily be following things online and so on. So the mining industry, not so much. Generally, it's still old-fashioned private equity type business with a lot of expertise involved. But we certainly saw with the cannabis industry, psychedelics, artificial intelligence driven companies, significant engagement from younger self-directed investors who are more willing and comfortable dealing in the online environment.
Do you want to know something interesting, by the way? Because I agree with you, but just from a data perspective, while it's true the top of funnel is filled, is more heavily represented in the kind of 18 to 30 demographic, the conversion rate amongst shareholders, investors who are 55 and older is way higher.
I would agree with that, Matt, all day long when looking at our Noble list.
Yeah. So it's true that kind of on the younger side, people might be more likely to come into the funnel, but they're more likely to come out of the funnel too, because they're clicking and they lose interest and they're distracted. And, we can theorize about this generation. I'll probably come up with the same list of attributes, but when individuals aged 55 and over come into a funnel and they click on content and they get interested in the company, they tend to convert much higher.
Okay, here's another one. This is for you, Matt. What's the benefit of a Reg A over a Reg D 506C?
So Reg A expands the list of eligible purchasers to non-accredited investors. 506C is a public solicitation, but it is limited to accredited investors. And there are criteria for eligibility that excludes huge numbers of people, millions of people, whether those are income-based accredited investors. I think it's 200,000 USD in annual income, or 300,000 USD in annual income together with a spouse, or net worth $1 million in financial assets, $5 million in net assets. That's the eligibility for someone to make a purchase in a 506 in a Reg D 506C. In a Reg A, you can solicit and accept orders from non-accredited investors as well. So, someone can put in $500, someone can put in $1,000. So it's truly all-encompassing to turn your customers into shareholders.
Here's another one. What about valuation? This is a good one because we all know the VC math is kind of hocus pocus. And if you have a company that's not profitable, which most early stage companies are not, how does that play into the discussion or the strategy of listing shares? I don't know, maybe Richard or Jason, somebody want to jump in on that one?
Well, I would say that, again, if you are public, so OTC, QX, and QB are markets, right? Those are SEC established public markets, which means for purposes of equity financing, the valuation is the public price. So the market knows what you're worth because the market has decided what you're worth, which is significantly different, obviously, than the private markets where you're going out and hiring somebody, or somebody's hiring somebody on their own behalf to decide what it is you're worth, and whether that's real or not real. We can debate that. We saw what WeWork was worth, and then once they opened their books, we saw what they weren't worth. And so that's the fundamental difference of the private market versus going the private equity route.
Yeah, we actually refer to the public markets as the ultimate truth tell.
Yeah.
Because again, as Jason says, the market is relentless in terms of evaluating your company, whether you're profitable or still in the development stage. And again, it depends very much from industry to industry what metrics are important. But say ultimately, the price is the price when you're in the public sphere.
I always am wary of a company that says we don't want to be in the public markets because the valuation. And you say, well, what are you afraid of? Because the public markets will tell you what your valuation is. And if you don't think it's going to be what you think it should be, then I don't think it's the public market's problem.
Yeah, it's efficient market theory, right? And sometimes the market's correct. Okay, so somebody says, I keep being told to avoid Reg A because of the litigation in the space. Smaller investors that are not accredited are difficult to deal with. And like Grant Cardone has multiple lawsuits over $10,000 investments. Is there any truth to this? I'm going to pass this over to you, Matt. You have a legal background.
So does Richard. So,
yeah, but I'm not a U.S.
I see.
I'll pass.
I guess I have to think about how to answer it. I can't immediately, I'm not jumping out of my seat saying yes. Oh yes, there's litigation. There's litigation in Reg A. I think if a company is comfortable making sales of products to individuals of a wealth level that where the product purchase is like $500 or $1,000, then I don't see why they wouldn't be comfortable selling shares to individuals with the same wealth profile. That's my kind of reaction without thinking about it too deeply. I do think there's misinformation out there about the dangers of a specific exemption like Reg A, which to me doesn't make any sense. Like the exemption under which a company pursues an offering is kind of technical, right? If they've got the chops and the value prop and the track record and the business plan and the authenticity and can win the trust of the public such that it's appropriate for them to be raising capital, then I don't think, picking the exemption. We can talk about that later, but there shouldn't be the hallmark of what people should invest in shouldn't be related to what the exemption is. It should be related to the company fundamentals.
I would also say that 10b5 risk and fraud risk is everywhere in every market, and so class action lawsuits, there are plenty of them on exchange listed securities. It's the action of the issuer. If you're going to commit fraud, you're going to do that either it's Reg A or on the New York Stock Exchange and anywhere in between.
I get hundreds of those emails a day, and I will say this: there's two things that Americans love to do, and one of them is sue each other. And I think that every time you walk out your front door, you're at risk of being sued. Unfortunately, so I'm going to ask this question's for you, Jason. What's your opinion about SPACs?
What's my I don't know that my opinion is that it was very popular and now it's not. You know,
Safe answer.
yeah, I think, there's a well-trodden path of how to access the public markets, how to grow your shareholder base. This isn't rocket science, doing the right thing, growing your business. SPACs provided an interesting opportunity. There were RTOs at one point. Reverse mergers were cool for a while, and something else will come along. The second, like, your favorite football star has a SPAC, it's kind of like that old story when your shoe shine guy is telling you what stocks to buy. Like, maybe it's run its course.
Yeah, it happens.
Yeah.
Here's a DealMaker one, because you have a lot of fans here today, Matt. But somebody's considering you or WeFunder, and WeFunder's a very active platform. So this is not to bemoan what they do. What's the difference between DealMaker and WeFunder?
So WeFunder is a crowdfunding platform. They won't do Reg A, and I don't know if they'll do 506 offerings as well. Someone will have to check that. But our value prop is we are here to support the issuer building a community, and we'd like to be a part of the issuer's kind of permanent, technology partner in turning that community into a source of capital. So whether that's a Reg D or whether that's a Reg A, both of which we can do as a broker-dealer, both of which we can support as a broker-dealer, or just, that permanent cultivation of that community. WeFunder, everybody can research and come to their own conclusions, but, we draw a distinction between our model, which is putting the issuer front and center so that they run their own capital raise, versus the portal model where, you go on the website and there's lots of offerings to buy. I think, issuers will have to decide, do they want to be, featured in kind of an online, bulletin board where there's lots of things to buy, or do they back themselves to build their own community, the sole kind of banner lead, everything behind their brand to turn their community into a source of capital? That's, I'd say, the major difference.
So I will add this. They do Reg A's, but one of the big differences is they are a funding portal. You are a broker-dealer. And there's some differences there. Do your due diligence, before you make your decision as to where you really want to raise capital. Somebody wants to ask about, the cap table and managing the cap table with many new investors. Maybe Steve, you want to jump into that, because that's something you went from like X number of investors to thousands of investors. How did you manage that?
It was not easy. Very challenging to manage our cap table. We do have a super voting class of shares, so the control of the company is always with me, which is something that we had in place from our inception. However, managing the cap table could be done way in advance, assuming that if you're execution based, and you're gonna hit this offering on the Reg A side out of the park, or this crowdfunding side of the park, it's fairly easy to just do napkin math to see where your cap table is and understand where your fully diluted elements are going to be in terms of, or you are fully diluted. So we managed it on an active basis, but we had a feeling we'd be successful. It sounds cocky. I promise you, I don't mean it to be that way, but it was a modest offering to begin with at the time. So we just kind of knew where our common share structure would be in advance and price things around that. But I'm not sure how things go on the private side if you're doing a Regulation A on the private side. But on the public side, we had a price per share, and with the notice, we could change that price per share, thusly reducing the amount of issued and outstanding shares we would have on the fully diluted basis, if that makes sense. So the higher our stock price goes, the fewer shares to raise the same amount of capital. And what was really interesting, the last thing I'll say, is that our stock price continued to get ahead of us during our offering because we were marketing our Reg A by this buy a product, buy a share mandate. That we noticed that that's exactly what was happening. People were buying a share in a product, stock price demand would be up, so price went up. Therefore, we actually diluted less than we had expected.
Okay, awesome. Thank you for that. So this is going to be the last question, and I'm going to start with Jason on this because it mentions you by name, calls you out, or mentions your company by name. My company has 10 million in revenue, has been around for over 10 years. We are near break even, and everyone keeps telling me to stay away from the OTC public market. I believe he means OTC markets, as it's full of traps, crooks, and pain. While I like sticking to the safe waters of Reg CF and maybe one day Reg A, I would like to find a route to liquidity for my early end shareholders. Any tips? Jason.
Well, obviously, I would disagree with that. The fact is our QB and QX markets are regulated. They are public markets that have rules and regulations around them. We are the only market that actually, goes out of our way to kind of advise investors when there are problems with the companies that trade on those markets. We put out promotion alerts. We put out alerts if a company is doing a dilutive financing that we think is not in the best interest of its investors. We put out alerts, like I said, for promotion or shell risk. So the OTC markets of today is significantly different than the OTC markets of 10 years ago. And the rules and regulations around the companies that trade on both those OTC, QB, and QX markets are significantly different. I would add, because this comes up often, and it's kind of a joke around here, but Stratton Oakmont, that everybody likes to think was, the guys from Wolf of Wall Street that did all these transactions OTC. The reality is that every offering that Stratton Oakmont did was on NASDAQ. Every single one of them. You guys can all look that up. And the reason they did that primarily was because everybody just assumes because something's on an exchange that there's this blanket of credibility around the transaction. And that isn't always the case. So I would say that, there's a tremendous amount of opportunity on our markets. Certainly the nature of the company you just discussed, right? There's a path to growth. And that path to growth can start here in the public market. And give stocks are sold, they're not bought. So companies have to do their work. But a public market and our public markets are a good place to begin that journey.
Matt, do you have anything to add as an enabler for capital raising under CF and A plus and D?
Well, I mean, in connection with the idea that the ultimate destination is some form of liquidity for the shareholders, I think that's the right way to think about it. I think it comes back to making sure you're delivering on your promise. When you bring in a shareholder, they have an expectation. And I think, founders who are approaching this correctly, and to use terms that others on the panels have used maturely, that they do have to have a plan. What Jason isn't saying, and I'm happy to say, I think in many respects, OTC markets is the perfect destination for a company that's engaging in a online capital raise or a type of crowdfunding offering. And Jason could say a little bit more about why, but I'm always wary of people are saying or advisors are saying, I don't know what agendas are at play. I come back to the message that we're trying to transmit. I think founders can do this themselves. They can raise capital themselves. They can speak to any of the members of this panel if they're looking for advice on what to do and what not to do. The information is out there. There's a lot of disinformation or misinformation out there, and we have to counter that. But this is SEC approved, U.S. Congress backed legislation, public market regulated. We do hundreds of these, so there are best practices and there are pathways to follow.
I would just add one thing. I'd be remiss if I didn't remind everybody that I did start with saying 85% of the companies that trade here are international. So we are the market for Roche, Adidas, Heineken, Marks and Spencer, Air Canada. So they're certainly not going to put their faith in us if we're a market of, hucksters and fraudsters. And in fact, we're getting the Novartis spinoff next week as well. So real companies trade here. It's not what people think it is.
Absolutely. So on that note, I think we're going to have to call it a day because we're once again past our time. I want to thank all my panelists, Jason, Matt, Richard, Steve. You guys were awesome. You did an amazing job. I would recommend anybody who is attending this webinar to reach out to them directly if you have more questions. And thank you for participating and best of luck to all. Thank you very much, everybody.
Thank you, everyone.
Thanks so much.
Thank you, everybody.
Thank you.
Appreciate it.